Assalamu alaikum, dear students. Hope you all will be fine. Today our topic is how interest rate are determined. I hope you will understand the previous topic of this chapters, that what does it mean by yield, does it mean by current yield, how we can calculate the current yield, yield to maturity, YTM, bonds, interest and coupons of the bonds, the Fisher equation is nominal interest rate, and etc. Today our topic is regarding to the interest rate determination, or how we can define the interest rate. So interest rate are determined in large part by the central bank of that country, who actively commit to maintaining a target interest rate. Central bank, they are targeting their interest rate, and on the basis of that they are maintaining their target interest rate. Central bank do so by intervening directly in the open market through open market operations. That is called OMU, open market operations. The buying or selling treasury security to influence short-term rate. So, as you know, that interest rate are the cost of the borrowing money that represents what creditors earn for lending you the money. These rates are constantly changing and differ based on the lenders as well as your credit worthiness. Interest rate not only keep the economy functioning, but also keep people borrowing, spending and lending. But most of us don't really stop to think about how they are implemented or who determines them. So the interest rate is, we know that the cost borrowing money and represent what the creditors earn to lending the money. Central bank raise or lower the short-term interest rates to ensure the stability and liquidity in the economy. Long-term interest rates are affected by demand for 10 to 30 years. Low demands for the long-term notes leads to higher rates, while higher demands leads low rates. Similarly, retail banks also control rate based on the market, their business needs and individual customers. Rate on individual loans are impacted by loan terms and the credit rating. So we have now two types of the interest. One is on the short term interest rate, Second one is long-term interest rate. So in those countries which is using a centralized banking models, short-term interest rates are determined by central banks. A government's economics observer create a policy that helps to ensure a proper or stable price and a liquidity. This policy is routinely, that is, checked, so the supply of the money within the economy is neither too large, which causes price to increase, nor too small, which can lead to drop in the prices. This was in the case of the short-term interest rates. Now the long-term interest rates, so that is demand for the treasury notes. Many of these rates are independent of the rate, and instead to follow 10 to or 30 years treasury notes yield. So these yields depends upon on the demand. So lower demand tends to result in higher interest rate. But when there is a high demand for these notes, so it can push rate down. If you have a long-term fixed rate mortgage, car loan, student's loan, or any similar non-revolving consumer credit products, so this is where it falls. Some credit cards' annual percentage rates are also affected by these notes. So these rates are generally lower than most revolving credit products, but are higher than the prime rate. Keep in mind, dear students, that many of the saving account rates are also determined by long terms, the treasury notes. Now we will discuss that how the interest rate through by supply and demand that are determined. So interest rate levels are the factors of the supply and demand of the credits. So interest rate levels are the factors of the supply and demand of the credits. An increase in the demand for the credit will raise interest rate, while a decrease in the demand for the credit will decrease them. Conversely, an increase in supply of credits will reduce the interest rate, while a decrease in supply of the credit will be increase them. Means that there is a direct relationship of the demand and interest rate, while indirect relationship in the demand in the supply and interest rate. How? Look at, if you are demanding for the credit, so if the demand is increasing, so what's interest rate will be increasing. But if there is too much credit available in the market, demand is less and supply is too much, so at low interest rate that loan should be sanctions. So interest rate level, or we discuss that this is a factors of supply and demand. So An increase in the demand for the money or credit will raise the interest rate, while a decrease in the demand for the credits or money or funds will decrease them. And similarly, in vice versa, in the case of supply, if supply are increasing of the credits or money, so they will reduce the interest rate. So an increase in the amount of the money made available to borrower increase the supply of the credits. For example, when you open a bank account, you are lending money to the bank. Depending on the kind of the account you open, like let's suppose we open this fixed deposits, the certificates of deposit, that is also called, will lenders a high interest rate than a saving accounts, with which you can access to the funds at any times. So the bank can use the money for its business and their investment activities in order, and we can say that if the bank can lend out that money to the other customers, so the more banks can lend, the more credits is available to the economy. And as the supply of the credits are increasing, so the price of the borrowing, means interest, will be decreases. If each and every banks, they are giving you more and more credits, so in this way supply will be increased in the market, and when supply is increased, so at that situation interest rate will be low. So credit available to the economy decrease as a lender decide to defer their repayments of their loans. For example, when you choose to postpone the paying this month credit card bill until next month or even later, you are not only increasing the amount of interest you will have to pay, but also decreasing the amount of the credit available in the market. So this in turn will increase the interest rates in the economy. Like look at, we all of us take loans from the banks, millions of loans we take. So monthly wise we pay back this amount back to bank. So in all of us 50% not pay back our loan amount to the banks. So in this way the supply will be decreased in the market. The money supply will be decreased in the market, and when that supply will be decreased, so in this way the interest rate will be increased. So hope you will understand this point, supply and demand, that how they are affecting the interest rate. Second one, factors that are affecting the interest rate is inflation. So inflation will also affect the interest rate level. The higher the inflation rate, the more interest rate are likely to be rise. This occurs because lender will demand higher interest rate as a compensation for the decrease in purchasing power of the money they are paid in futures. So inflation rate is also affecting those economies where the higher the rate of the inflation, so the interest rate will also be high. And when the interest rate, the inflation are high, so automatically they will, lender will charge high interest rates. But on another side, those countries where the inflation rate are controlled are less. So the interest rates over there is also low. So there is direct relationship between the interest rate and the inflations. If the inflations are high, interest rate will be high. If the inflation rate are low, interest rate will also be comparatively low. Next one, that is governments. The government has a say in how interest rates are affected. Mostly, dear students, the federal funds rate, or the rate that the institution charge each other for extremely short-term loans, that is, affects the interest rate that banks sit on the money that lend. They trade then eventually trickle down into other short-term lending rates. So in open market transactions, they are influencing, which is the buying or selling of the previously issued securities. When the government buys more securities, so banks are injected with more money. Then they can use for the lending and borrowing, and the interest rate will be decreased. When the government sells securities, so money from the banks is drained for the transactions, is withdrawn, and rendering favor funds with the bank, less funds remaining with the banks for the lending purpose. So they forcing to raise the interest rate. So in this way, government are affecting in the interest rate. So dear students, hope you will understand this topic. If you have any problems, so you can put a message in the group. For now, I will finish this class, and inshallah will contact in the new class.